Hello, everyone, and welcome to our webinar on disaster and casualty losses and related tax rules with a focus on hurricanes and hurricane damage. My name is Sarah Campbell. I'm with USDA. We are also joined today by JC Hobbs, who is with Oklahoma State University. FSA has partnered with tax experts like JC to bring you all monthly relevant content regarding taxes and your farm operation. We recommend visiting farmers.gov/taxes. All of the resources and information that have been developed from prior webinars is on that website, and that is where we post all the latest and greatest when it comes to our farm tax education efforts here at USDA. This webinar is being recorded. It will be captioned and posted online alongside the slides. It just takes us a couple of weeks to do that captioning and get everything put together and put online, but you'll be notified by email when that happens. If you have questions during the presentation, please put them in the Q&A box, and we will answer those at the end. So without further ado, since I know folks have a lot of really important questions, and this is a very timely topic, given the recent disasters, I'm going to hand it over to JC.
Thanks, Sarah. As she said, we're going to be talking about disaster issues that applies to the hurricane. It can be a lot of other things, but basically that's where we're going to target this session. This information is part of work being done through a grant from USDA, and we are with Rural Tax Education. We're part of the National Farm Income Tax Extension Committee that works with the Farmer's Tax Guide with the Internal Revenue Service. And what we're trying to do here is provide educational information as it applies to the tax laws that work off of these casualty losses, particularly when we get into the issues of this hurricane, which were very widespread and very deep. So remember, none of what was being presented should be considered formal legal or tax advice. We're trying to give you information for education. We're also hoping that this information would helps you work with your tax professional to look at your specific situation, because everybody's situation will be different. All the tax issues that apply will vary by individual and what has happened. So we'll be talking about all kinds of pieces of this, but remember, you have to look this over very carefully for your specific rules and explanation of what happened to you. The website is hosted by the Utah State University. Materials have been developed by our National Farm Income Tax Committee. And there's a variety of topics on the RealTax.website, realtax.org, that you might want to look at, but I don't want to spend much time on this today. So here's the material. These tax issues, this whole presentation, there's information that I put together via Oklahoma State University. Also, the Center for Ag Law and Taxation at Iowa State University is providing a lot of the information as well. I put their information or their slides in here. They have some great information. It'll be very helpful. So what we're looking at is, again, providing for you, the farmer and rancher. We're not trying to make you a tax expert, but we're also making sure that we cover all the items when you look at these losses due to a weather event, particularly the hurricane. Inside the presentation, you'll notice spots that are highlighted in yellow. These are what I want to bring your attention to. You'll also see items that are in italics. Those items provide information for your tax preparer to help them find the information in the tax law and the tax code to help file the return properly, complete the tax return, and get it done. So we're providing information basically to explain to the farmer and rancher what's taking place, plus then provide information that you can take this presentation, these slides, to your preparer and have them, or make it easier for them to find the necessary spots in the code where the rules are found. So when you look at this, here's our overview of many farmers, ranchers. A lot of farmers and ranchers suffered damage and loss last year due to hurricanes. That's what we're targeting. We're going to look at the in-depth review of the disaster provisions. We'll talk about how to calculate some of these gains and losses, because believe it or not, depending upon what is going on, insurance, etc., there may be situations where you have a casualty gain as well as a potential for casualty loss. It does happen, and there's ways to mitigate the tax bite. There's deferral of gain for involuntary conversions that we'll cover. And then we'll look at crop insurance. When we lose a crop, it may have been insured, so it would pay off. How to defer that crop insurance payment so it doesn't pile income or stack income into 1 year. Looking at disaster payments, kind of the same way. Gain from the sale of livestock, if you had to sell animals due to loss of pasture, how to then not report all the gain in the year of the sale, because that's not going to be a normal situation. And we'll get into the details of all of this as we go through. So basically, when you look at this, and there's a court case here, goes back to 1931, that defines what a casualty is. It's damage or destruction, or loss of property caused by an event that we can identify that is sudden, unexpected, or unusual. So damage, destruction, loss of property, natural disasters such as these hurricanes, tornadoes, floods, derricos, hail, etc. Wildfires are also included in some of this. Now, the tax treatment. It depends on a lot of different factors. The first bullet there, damaged or destroyed property was used in a trade or business or held for the production of income. Those rules are much different than items that are held for personal use. They're also sometimes different based upon what's going on as to how the rules apply and how much is deductible. We'll also look at how much the property had been depreciated. Machinery and equipment, breeding animals that we purchased. You buy them, you're allowed depreciation deductions against that. So what is the tax basis? Because that helps us to determine what the amount of the tax loss will be. If there's insurance proceeds that were received, those have an impact, and whether the damaged property was either restored back to use or it was replaced. So all those items have an impact on the tax treatment. We have to look at the facts and circumstances of every individual case. So as the farmer or rancher, to consider the taxpayer, they experience these damage from these natural disasters. Remember I said up front, we could have a casualty loss, casualty gain, or we may have the ability to defer that tax bite if it's involuntary conversion to a future year. So when we get into this process, we have to look at what we call the basis of the property, the tax basis, what the value of that is in the tax return. So business property or property held for production of income, we start with what the tax basis of that is. That's the adjusted tax basis of that damaged or destroyed property. So the adjusted tax basis, we give you the code sections there. Again, take this to you prepare, but what it is in its simplest terms, it's the cost. This is generally the cost of the item, the asset, less any accumulated depreciation. That accumulated depreciation can also be the Section 179 expense election, where we're allowed to write off the cost of certain items that fall within a price range in the year that it was purchased. Also, we take into consideration any value improvements that were made to that property. So cost less depreciation plus improvements give us the tax basis, and that is the beginning point of where we look at what is the loss that would be attributed to this hurricane as it went across our farm or property. The next code section, 1016, it says it requires taxpayers to adjust the basis of a property for expenses, receipts, losses, and other items chargeable to their capital accounts. Basically, what this means is when you look at let's use a tractor, make it simple. So we have a tractor, we depreciate that down a ways. We have some other expenses. We have some maybe other items in there. Depending upon what's going on with all this, we look at our value of those items, and that becomes the amount that we look at for tax return preparation. Now, let's talk about the business casualty losses. So these are items used in the production of income. These are farm business assets. Doesn't have to necessarily be a farm. Could be a small business in town, mom and pop grocery store, all of those items. So as long as that asset is used for the production of income in a business, the casualty loss rules that apply there are talked about in the next two bullets. What happens? So though property is damaged or destroyed, the taxpayer is allowed to deduct that casualty loss incurred in that trade or business or any transaction entered into for a profit. So as long as we have a profit motive, there's a good chance that that's a business casualty loss. And that calculation depends upon whether the property is merely damaged or completely destroyed. If it's damaged, we use one set of calculations, and I'll explain those. If it's completely destroyed, no longer usable, then there's a different set of calculations that do apply. Now, personal casualty losses. So when we passed the Tax Cuts and Jobs Act in 2017, the rules become applicable in 2018, and they go through 2025. So losses of personal use items, these are non-business items. These are items that are strictly for your pleasure and benefit, your personal vehicle, items in your home, things like this. If losses to those items, they're only deductible if they arise from a casualty attributable to a federal declared disaster. These hurricanes, they resulted in a federally declared disaster. Therefore, you're going to be able to deduct those losses much easier to a much higher level than just the amount of your normal allowed contributions to charity, like charitable donations, etc. So it's above and beyond your standard deduction. It does not apply to losses on income producing property. Those are business type items or income producing items, and the person, so they're not personal business. They are treated differently. Now, this issue with the personal items, they were supposed to expire in January 1 of 2026. What we don't know, given the election results, will this be extended beyond 2025? Because the Trump era of the first election was what brought these into play in 2017. They were put into play and allowed to hold till 2025, supposed to expire next year. Since he was reelected and since some of the Republicans are reelected, will this continue? Possibly, but I can't guarantee it. So you have to watch what's going on next year. Watch the news, etc. But more than likely, these will be extended. So what happens when we have property that is damaged but not totally destroyed? So we didn't lose it all, but it had some damage, roof damage, it messed up some fences, this type of thing. The amount of that loss that we calculate, it's equal to two parts, either the lesser of the adjusted basis, that's the cost, less depreciation, plus any improvements that were made, or its decline in value, which is the fair market value of that property after the disaster compared to the fair market value before the disaster. So the decline in value looks at the change in the fair market value both before and after the disaster struck, minus any expected insurance or other reimbursement that could be received or will be received. So again, adjusted basis or decline in value reduced by then any expected insurance or reimbursements that we do receive. There's a Treasury reg again. Hopefully this situation occurs again. take this presentation, we're going to fix it up so that you can have it, and take it to your tax preparer. Provides them some assistance, saves a little time. Here's an example of what we're talking about in that prior discussion. So we have a multi-purpose farm building, a machine shed. It's severely damaged by hurricane force winds. His adjusted basis in that building is $100,000. So when he put it in place, it cost him some money to put it in place. Let's say it was $175,000. We take $75,000 of straight line depreciation. So now, when the hurricane struck, our basis in that was $100,000. Now, the fair market value of the building, so if we'd have sold it to somebody else in a arm's length transaction prior to the storm, if that was $200,000 and the value after the building after the storm was $150,000, well, there's your decline in value. So we got $50,000 there. If he gets $40,000 of insurance proceeds to compensate him for that damage, how is that calculation or the loss calculated? Well, here's the answer. So the decline in the value is $50,000. That's that adjusted basis or the decline in value. So the adjusted basis was $100,000. Decline in value was 200 less than 150, so $50,000. The insurance payment's $40,000. So our casualty loss in this situation is only $10,000. Now there's two pieces in italics here. We don't really need to get into that for your benefit. It gets rather technical because what I'm talking about here is how it's reported on the return and with all the forms that are needed. So his basis in the barn is decreased then by the insurance proceeds received and the casualty loss that is recognized. If he spends money to restore it, then we increase that amount. So now let's look at the new basis in the barn after the recognized loss. That was $50,000. That's the $100,000 minus the $40,000 minus the $10,000 that we had of casualty loss there. John uses the insurance proceeds, that $40,000 increase. So the $50,000 recognized loss plus the $40,000 insurance proceeds to restore the roof, that increases that basis to $90,000. So the next time when we sell it, that building or depreciate it, $90,000 of tax basis that we can use recaptured through depreciation. It's a little complex, but basically you're going to see there, this is how it works, and your tax preparer will understand how it works and why. So you don't get quite as much bang for the buck, but you're not penalized nearly as bad either. So what's the fair market value? How do you determine that? Has to be established in the property before the casualty. How do you do that? It's going to be an appraisal by a competent appraiser. And that's the rules from IRS. It has to be a competent appraiser, somebody that understands the farm assets, etc. Or you can use the cost of repairs. So if we have the building that's damaged and the cost to repairing it and bringing it back to use, that can be used as a proxy for that fair market value before the casualty. Fair appraisal is a great way as well, but you've got to look at both of those. The IRS then reviews each return based on particular facts and circumstances, and they do look at these. What happens if we don't report it correctly? Well, if we try to cheat the system, there's what they call underpayment of tax penalties for if we overvalue what that either the appraisal was, the fair market value to begin with, and that's usually the case. So you want to be realistic what that property was worth before the casualty occurred, before the hurricane occurred. Be reasonable. So the decrease in fair market value, basically after the disaster, is much different than what it was before. So now we've got other things after the disaster occurs. Our fair market value, we have to consider the cost of cleaning up or repairing that property. Those can be used if the following conditions are met. Those repairs have to be made. We can't just say, well, we're going to do it and say, well, the estimated cost of repairs to get it back up and running was 50,000. No, you have to actually spend the $50,000 to get it done. And they has to bring the property back to its condition before the casualty, not above and beyond, but to the condition it was before the casualty. So it can't be excessive. It has to only fix the damage. And the value of the property after the repairs is not, due to the repairs, more than the value of the property before the casualty. So the barn, say, was worth $100,000 before the casualty occurred. We look at it after we do all the fix up, clean up, etc. It can't be more than that 100,000. Otherwise, we've got a problem. So $100,000 for beginning value. After we get it all fixed up, the decrease in value plus then all the improvements, we've got to make sure that that is not greater than the original value of the barn. So what happens if property is completely destroyed? And we've seen some of this. Heard about dairy barns completely washing away. Corrals completely washing away. So it's gone, completely destroyed, not to come back. Then the fair market value, or the decrease in fair market value, is not considered. That goes away. There is no decrease, it's gone. So the casualty loss now is equal to that property's adjusted basis. So that was the cost of the barn, less the depreciation taken. Let's say was a $100,000 barn, we depreciated it by 25,000, so the value of that barn, adjusted basis, is 75,000. It's completely destroyed. If there was any salvage value to that, so there's some pieces that you can actually sell off, which is usually not the case, or if there's any insurance proceeds that the building was insured for, we reduce that 75,000 by that. Otherwise, the complete destruction, the amount of that casualty will be the 75,000. But if we had insurance to the tune of 50,000, then our casualty loss that we would be allowed to take would be only 25,000. Now, those insurance don't have to be received before we do the calculations. So when the tax return is filed in 2024, if we haven't received the insurance reimbursement, we have to put down what we expect to have received. And then when we receive it, we may have to make an adjustment on the return. So example 4.2 here. This is a second example. Helena had a hog building, fair market value of 250,000. The adjusted basis was 150,000. It was completely destroyed by the hurricane. If she gets $100,000 in insurance proceeds, her casualty loss is 50,000. That's that adjusted basis of 150 less the 100,000 insurance proceeds. She doesn't get to claim the whole 150 because she got some insurance money to kind of help mitigate that loss. So her casualty loss is $50,000. Now, in parentheses, there's the basis, insurance payment, fair market value. Those are all reported. And again, that's for the benefit of your tax preparer. Now, if some of that property has to be demolished before we can do anything else. So in other words, it's destroyed, but in order to put up a new building, new structure, etc., we have to demolish and clean up. Those demolition costs and the basis of that property, of any of those destroyed structures, it's what they call capitalized. It's added to the basis of the land on which the demolished structures were located. So the cost of cleaning up, demolishing what was there, the original basis, not allowed as a deduction, but is added to the basis of the land. So let's say the land was worth $100,000 that this structure sat on. After we do all the cleanup, everything, getting ready for put the new building up, cost us 50,000. Now our basis in the land is increased by the 50,000. Then if we go in and replace the structure, then we're looking at the new structure's cost being what's going on there. So when it actually damages or destroys a structure demolished, the basis of that structure must be reduced by the casualty loss and that demolition cost. And that, look at IRS notice 9021 to walk through the process. Here's a further example, the last example, that destruction, destroyed the hog building. We subtract off those insurance proceeds. And if you look at the casualty loss, well, there it is 0. Any demolition or removal costs would be added to the basis of that land. So remember, it was completely destroyed. So the value is 0. The demolition costs would be added. The cost of the new building would become the new building's basis. So here, let's go into detail exactly what's going on. The hog building was located on a 10-acre parcel. She bought it in 2010. She bought it for $50,000. She pays $10,000 to have the destroyed building demolished and removed. The building site is then restored. The basis of the land now is the 50 plus the 10, so $60,000. When she buys or spends the $300,000 to rebuild the hog building, the basis of that building is now $300,000. So the $10,000 of cleanup goes to the land. The new building stands on its own. So the rules, business casualty losses are determined on a property by property basis, asset by asset basis. So let's say we had the dairy barn, it was gone. Then we have a tractor and some other equipment. We have a grain storage facility, grain bin. Each one of those items are separate pieces of property, and we have to look at the losses and determine that for each individual piece of property. We're not allowed to aggregate them all together. We have to look at each one of them independently, and then when we're all done, we add the numbers up or add the numbers together. Any negatives we subtract off so that we end up with the calculation of what that casualty loss actually is. But remember, it's on a property by property basis. Each individual asset is looked at separately. So the taxpayer, the farmer, elect to take into account any loss occurring in a disaster year or disaster area, especially when it's a federally declared disaster. And we can take that loss that occurs, and let's say 2024 is the year that these hurricanes happened. We can elect to take that loss that would be generated on the 2024 return and make an election to carry that back and amend the 2023 tax return. The reason for doing this is to give us some tax or some dollars to work with, because we would get a refund on the 2023 return. Instead of having to wait until the 2024 is all worked through, we may be able to get some definite larger benefit, especially if you look at when this did occur, if there were some rules or things that took place, we had a lot of income coming in, etc. In 2023 that we didn't have in 2024, we may want to go ahead and carry that loss back to 2023, get a refund, and to do so, you make that election on an amended tax return for that prior year, the 2023 year. Again, this is a tool to give us some relief, give us some cash to operate with while we're waiting on things to get cleaned up. But the problem is, if you deduct that loss that occurred in 2024 in that prior year, you're not allowed to have any reimbursement or anything received in the 2024 year. So you're going to carry it back to 2023. That anything that comes into 2024 then becomes taxable. So it's not a bad rule. It can help. Something to think about, something to work with your tax preparer on. They can help with some planning issues here to make it work to your best benefit. Now, insurance proceeds create a little different ballgame for us. So if we have those assets that are insured, and again, remember, it's on a parcel by or asset by asset basis, and we have to look at the casualty losses based upon actual or expected proceeds from those insurance policies. We may get some of that insurance before or early on. Some of it may take a while before we receive that. So you have to file a return. You have to include what we expect those insurance proceeds to be. Usually we can get close. So the casualty loss reduced by those insurance proceeds, whether we receive them or not, And even if that payment won't be made until the following year. So let's say we don't get payment until way late in 2025. We still have to make that calculation based upon what we expect to have in terms of insurance proceeds. So when the year of reimbursement, let's say it's late 2025, then we're going to have to adjust the amount on the 2024 tax return. So what happens if the reimbursement is less than what we expected? Well, then we have a loss that's realized on that in the year of reimbursement. If it's more, we have income, but only to the extent that that originally casualty loss deduction reduced the tax for that prior year. We don't have to get hit twice. Your tax preparer will understand the rules on this. So those are the casualty losses, but we don't always have a casualty loss. Sometimes we will actually have a gain. Doesn't happen often, but it can. Sometimes we have assets with insurance, and that insurance coverage is phenomenal. So the insurance compensation for the taxpayer receives more than the adjusted basis of that property. So what happens is, this is often the case when we're looking at farm property. So we have a casualty gain and not a loss. When does this occur? We bought a farm tractor a few years ago. What did we do? We immediately wrote off the cost of that tractor. We expensed it using the 179 or bonus depreciation, so that our adjusted basis this year on that tractor is zero. The insurance compensation on that, we may have had insured for $50,000. Since the adjusted basis is zero, now we've got a $50,000 casualty gain that is potentially taxable. I said potentially. Last bullet there. If you have a casualty gain, there are code sections in the tax law that allows you to defer paying tax on that gain if we elect to reinvest the proceeds. So that tractor, let's say it was completely destroyed and it had a zero basis. We get $50,000 in insurance. Under normal circumstances, we'd have to pay tax on the $50,000. We decide we're going to replace that tractor. As long as the replacement tractor costs more than $50,000, we can defer the gain by reinvesting those proceeds. That gain is deferred until we sell that replacement tractor. So we kick the can down the road several years. That gain, how is it calculated? Well, there in yellow, it shows you the amount received as insurance proceeds minus the adjusted basis in that property at the time of the casualty or theft. That's in the tax code. That is the gain that is potentially taxable. Now, even if the decrease in that fair market value of the property is smaller than the adjusted basis, we still have to use that adjusted basis to figure the gain. So if the fair market value is lower than the adjusted basis in that property, well, you can't use the fair market value. You have to use the adjusted basis. That's the way the rules read. So let's look at the next example. So we're going to kick this thing down the road with Helena again. So she took the 179 expense deduction when she built her hog barn, the building. Her basis in that building was zero when the hurricane struck. So we have $100,000 of insurance proceeds from the for the destroyed grain bin. That's a casualty gain. And I think that should have been a hog building. I'll have to fix that in the slides. So the gain on that building is reported on the form 4684. Again, this is for your tax preparer's benefit. So the report is that gain is ordinary income, but it's not subject to self-employment tax. If she decides to recognize the gain on the tax return, but if she decides to use the involuntary conversion rules, we're going to talk about that in the next section, then we can defer that tax. We don't have to pay it up front. we wait until something else, a future event that results in the sale. So the casualty gain, presently taxable, depending upon whether the insurance proceeds are reinvested in replacement property. If they're reinvested, then we can avoid paying the tax on that gain. Like I said, we're kicking the can down the road. So when we sell that asset or do something else at a later date, that triggers when the tax bite will hit. So we're postponing it, and depending upon what's going on, it can be postponed forever. Again, depends on what's going on and what's happening. The basis of that destroyed property, it's carried over to the basis of the new replacement property. And then, like I said, the gain recognized upon the future sale of that replacement property. So we can move things down the road quite a few years to give us, again, some major relief when we have an involuntary conversion that results in a potential taxable gain. So we have to buy that replacement property. It has to be similar or related in service to the property that was destroyed. There's also some other things there, but that's for corporation. I'm not going to get into that. It has to be, in most cases, replaced within 2 years after the close of the first taxable year in which the part of the gain is realized. What does this mean? If you look at it in this terminology, the loss occurred in 2024. We make the elections. Now we have until 2026, sometime within the years of 2025 and 2026, to purchase the replacement property and get it into service. So 2 years. Depending upon other things that's going on, the Secretary of the Treasury may extend that period. So you have to kind of watch what's taking place. If we're still trying to go through recovery on these hurricanes, we may get an extra year. Don't count on it, though. What happens if it's a personal residence? Well, if we're in a federally declared disaster area, we can then have 4 years to replace a personal residence and defer the potential taxable gain on that. So not just 2, but a personal residence, if it's in a federally declared disaster area, then we have 4 years to replace that particular asset. So what are the rules in making these elections? We have to report the details of the involuntary conversion. So we're going to have to list out what was there. For example, when we fill out the forms, we need to take into consideration where the hurricane was, the FEMA numbers or the presidential declaration numbers, those types of things that apply. We include that information in the return that we are making the election to not report it since it's an involuntary conversion due to a casualty. Then we put that statement with the return. Again, it contains all these details. Has to be done in the first year of when it's realized, that loss is realized, or the gain is realized, the gain rather. And then when we replace that or we acquire the replacement property, we attach another statement showing that not only did we defer it the first time, now we have the new replacement property in place, and it contains detailed information about it. So let's say we had a tractor that we elect to defer the gain in 2024. We elect to replace that tractor. So we write down the information about the tractor, what its basis was, information on the casualty. When we buy the new tractor or replacement tractor, we include information as to what it cost us. The disaster is referenced where we lost the old tractor, and then additional information about cost, basis, etc. on that piece of equipment. So you want to include a lot of details. So Helena, again, elects to defer recognition on that gain. If she spends at least $100,000 to construct another building within 2 years, she can actually defer recognition. So if she chooses the deferral, she reduces the basis in that new building. I'll get grain bin out of there. The new building in the amount of $100,000 to account for that casualty gain. It's amazing. I went through these slides many times and I kept missing that. Here's the deferral statement. Again, take this to your tax preparer. This shows him what he needs to have included with the tax return. It's the code section. What we're doing is not recognizing the gain on that involuntary conversion and a compulsory conversion. We show that we elected, what the value of the property was, what it was, etc. So our intent to replace that converted property within that replacement period. So there's the election that has to go with the return in the year that we make the election. Hopefully that provides a little bit of assistance. Now there's some special rules that apply for federal disaster areas. If it's tangible property, that being non-real estate, non-farmland, non-buildings, replacement property held for use in trade or business is treated as similar or related in service as to property that was held for the use in trade or business or in reinvestment if, and that's a big if, the property being replaced or was damaged or destroyed in a disaster and the area that it occurred was declared by the President of the U.S. to warrant federal disaster assistance because of that specific disaster. So they get federal assistance, and we're pointing to a specific disaster that occurred. So Helena, in her situation, she was in a federally declared disaster area. She could defer recognition of that gain by purchasing any tangible trade or business property. So in this situation, she decides not to rebuild the hog building. Another good example of this, we decide we're not going to go back into operating a dairy. So we're not going to rebuild a dairy barn, but we're going to build something else, a similar type structure or a structure that we're going to be using on the farm. In that situation, we can defer the gain, subtract it from the basis of the new tractor purchase for her farming business, so that we can do this. So if she can't use a building, we're done. We don't have to put it into another building. We can actually put it into a tractor. There are rules that allow us, because it may not be feasible to put back that dairy or that hog building. We're going to get out completely, but we can purchase a different asset as long as it's used in the farm business. It's allowed. So those are the damage and destructions. Now, what happens if we decide to repair it? So we decide that we're going to repair the damaged property. We look at the reduction in the basis. If it's less than or equal to the taxpayer's adjusted basis in that building, amounts paid to restore the damage are capitalized as an improvement to that building. So what does that mean is once we figure out what the new pieces are, as long as it's capitalized into the improvement, at some point in the next year, we'll be able to depreciate it. So they're not lost. The capitalization means all we do is add it to the basis, that becomes depreciable. So if they exceed the adjusted basis of that property prior to the loss, the amount required to be capitalized is limited. Those are the rules. In that case, the costs required to be capitalized are limited to the excess of the adjusted basis, and anything above that is probably going to be taxable. But so we're going to have to keep track of all this. So the casualty minus the amount paid for restoration, that constitutes restoration under one of other some criteria there in that Treasury reg. Like I said, you're going to need to take this material to your tax preparer. So let's look at how that applies. Storm damaged Jerry's farm building that had a $75,000 adjusted basis. He gets $75,000 in insurance proceeds to compensate for the damage. He then pays $90,000 to repair the damage and restore the building to its prior use. So we get $75,000, but we put another $15,000 of our money to get the total of $90,000 that we're going to spend to repair the damage. The insurance payment that he gets lowers the basis of that building to zero. So the adjusted basis is $75,000. Insurance is subtracted from that. That's where we get the basis of that building being zero. He puts the repairs to the building. The $75,000 are repairs to get it back to the original amount that's at the insurance payment are capitalized, then he can deduct the extra 15,000 as repair costs if they were expended to repair and or restore the building. So they're not lost. This explains how they get it, how it all works. So you're allowed to depreciate part, and then the other part you get to take a deduction as a repair expense. Like I said, this is kind of complex stuff, but this explains what you need to do. Personal use property, personal home, personal residence, cars that are not used in the business in any way, shape, or form, other vehicles. So casualty loss, again, you can look at it from the personal property, it's allowed. Their rules are very different. It goes back to the Tax Cuts and Jobs Act, changed the law in 2018 through 2025. So that only personal casualty losses being deductible if they are attributed to a federal declared disaster area. Well, these hurricanes were. Outside the disaster area, so if there was damage to something that was part of the hurricane, but let's say you were in another state and you just saw some of the remnants of the hurricane doing the damage, well, that personal casualty loss remains deductible if the taxpayer has a personal casualty gain to the extent of the loss, so you net the two together. So in other words, outside of the area, you better hope that property has some insurance. Because if it's not insured, that loss is going to go away. But if there was some insurance that was paid to you, insurance proceeds, that resulted in a gain, then you're allowed to reduce that gain that would be taxable by the loss that occurred. Then you get to take the deduction for that. So you don't pay tax on the whole bit. Note, this is likely to be extended beyond 2025, again, based upon the results of our recent election. The loss of personal property, federally declared disaster area, you've got two limitations. Now, this comes back to being able to take it as against our adjusted gross income as basically a loss. Loss, we have to look at each piece. The loss must exceed $100 in order to be deductible. Aggregate those losses. They may be deducted only to the extent that they exceed 10% of the adjusted gross income. So we don't lose it, but it is certainly curtailed by a fairly sizable amount if it is to the loss of personal property that is outside of that federally declared disaster area. So you got to look at those two loss limitations, the $100 or the 10% of adjusted gross income. Then if you've got property that's partially used for business and partially for personal. So we've got a farm or a pickup that we use 50% for business use and 50% for personal use. The loss of that, we've got to look at and make the allocation. Half of it's personal, half of it's business. So you only allowed the loss for, you have to compare each part. So one of them will be allowed as a complete loss. The other one's going to be a personal use loss. Consequently, you're going to have to apply those two limits that is in the yellow right above it. So those involuntary conversion rules, they do apply to personal use property. As I stated before, that house may have that 4 years to replace it. So those are the big pieces of the assets used in the farm and business operation. Then we get into what the other things that we have on the farm. That's be the crops, that'd be the livestock, some other pieces of this. And what happens when we lose a crop? Well, we have disaster proceeds. We have disaster proceeds that come to us from Farm Service Agency, etc. Well, the rules state those insurance proceeds for those disaster-related damages, those are included in gross income, basically because that is replacement of the crop loss. So insurance proceeds cover crop damage, crop losses, is going to be includable in gross income. So you're the cash basis farmer, you're going to report those in the year when the income is received. So let's say that we've got the loss occurring in 2024, which we did have a loss. Between now and December 31, we get an insurance payment from our crop insurance provider for our crop loss completely there. Then we include that payment by rules in income in the year of the receipt. So it's going to show up in 2024. But there is a potential election to defer some of that income, possibly all of it. Explain how that works. So here's the code section that talks about it. Cash payments farmers elect to include crop insurance proceeds in gross income, not in the year that we receive that crop insurance payment, but in the following tax year of that destruction or damage. So 2024 is the year we can possibly move part of that insurance proceeds into 2025. Avoids income bunching so that we don't have all these crops that we typically sell crops that in 2025, but due to the destruction, we got paid for it in 2024. Therefore, we can make the election to move part of that payment from 2024 and report it on our 2025 tax return. It gives us, again, like I said, the idea is to avoid the bunching of income in the year that it was received. It's not available if the proceeds are received in the following year of the damage. So let me explain that. So the crop is lost in 2024 due to the hurricane. We don't receive the insurance proceeds until 2025. No matter what happens, that can't be postponed until 2026. It's going to be reportable in income for the tax year 2025. It can't be moved. So the only time we're allowed to move it is when the destruction occurs and the insurance payment occurs in the same taxable year. So what payments qualify? The insurance payment received as a result of destruction or damage to crops. Doesn't work on the revenue side, so it's only the destruction or damage. It also applies to those disaster payments from the federal government. And there's a Treasury reg that talks about extending those elections for all crops, federal payments, as a result or destruction or damage to those crops caused by natural disasters. It could also be the inability to plant crops. So let's say we were getting ready to plant something, the hurricane comes through, now we're not able to plant that crop. That works as well. Doesn't matter if it's loss or inability to plant, also known as prevented planting. In those situations, those are allowed, that federal election to postpone does apply. So in order to be able to defer that, we have to use the cash method of accounting. What does that mean? Well, the cash method of accounting, 98% of our farmers, probably a little closer, higher than that, use the cash method of accounting, not the accrual. So cash method of accounting simply means that when I receive a check, that the moment I receive it, it's includable in income that year. Whereas if it's an accrual base, it's reported in the year that it actually applies, whether or not you receive the cash or not. So cash method of accounting, you report cash income when you receive it. You report cash expenses when they are paid. Like I said, more than 98% of our farmers apply to this. So under our normal business practice, that's what we have to establish, that under our normal business practice, income from the sale of that crop would have been included in gross income in the tax year following the year of destruction. I see this quite a bit in the Corn Belt where they'll have corn harvested in late in the year. They'll sell part of the crop before Christmas and then the rest of it after Christmas. If our normal process is to sell it in two parts, then we can make a deferral to the amount that would normally be reported in the following year. It's made for the entire trade or business. We have to look at then all the disaster and crop insurance payments. They're treated the same. We have to generally elect all or none to be deferred. You can't just pick and choose. So again, normal business practice, what does that mean? Normal business practice is the way we normally sell crops between years. So if it's our normal practice, we sell part of it 1 year, part of it the next, then all we have to do is make a declaration on the election statement showing that this is what we normally sell in the year of harvest. This amount is normally sold in the year after harvest. It can be a percentage, whatever. All they're doing is dealing with making sure that we don't bunch the income. Within the how must show the taxpayer would have reported that substantial portion of income in the year following the damage or destruction. So they're allowed to do that, even though the crop is lost. We're still allowed to then make that election, move the indemnity payment, split it apart. And if you look at then some of the rules, now it talks about the 8th Circuit here. That is the Midwest. We left it in here just to make sure that, again, the tax preparer understands that what we're looking at. But outside of that, so the folks in the hurricane areas don't have to worry about that. It's allowed for any portion thereof that's moved between 1 year between the crops. So it does not apply to crops when receiving damage payments in the 8th Circuit. So for the most part, I left that in there just in case, but I'm seeing that this really doesn't apply for the Carolinas, etc. Example that shows up here, we have the Royal, he gets $12,000 of prevented planting crop insurance coverage for a soybean crop that he was going to plant. He gets $8,000 of disaster insurance payments for the damage to that to his corn crop. He operates that, normally sells the corn and soybeans in the year after following harvest. In that scenario, you can move the income from that from 2024 into 2025. So the disaster payments can be moved, and then the insurance payments could be reported in 2024. I may have stated that wrong. Let's go back and look at it. He operates both corn and soybeans, normally sells those in the following year, but he can elect to report one in the disaster year and one in the other year. Crop insurance later, disaster in 2025. The reason he can't report them in the same year, it's a single trader business. He must elect deferral for both crops or for neither. Doesn't matter what disaster, they are both treated as crop insurance and must be treated as one payment. So here's the answer to that prior one. He can't do what that split was. He has to report them individual or combined. If he historically received substantial similar income from his corn crop and his soybean crop, and sells 60% of the corn crop in the year of harvest and 65% of soybean crop, would he be eligible to defer that recognition if he is outside of the 8th Circuit, which for the most part you're going to be dealing with? More than likely, these hurricane areas, they're going to be outside the 8th Circuit. You're going to be allowed to do that. I put in here maybe, but from everything I can find, it looks like that's going to be allowed. You'll have to look at your specific tax situation to make sure that that does apply to you. So here's the next part, planted soybeans. Again, he can take them partnership. If this applies to you, read through that example. I want to pass it by. I think we got more important things to talk about. So the election to do this, to defer that income from 1 year to the next, you've got to be, it's attached to the return. It's a separate document. It is signed, and it states that the year of the damage and destruction occurred. It points out the election, what we're trying to accomplish. Once made, cannot be revoked without consent of the IRS district director, and those are required through a letter to the director. So this requires a letter being written to ask for that election to be revoked. Now, Farmer's Tax Guide, IRS publication 225. You read through there, it talks about then and gives a substantiation to some degree for why those proceeds received from revenue insurance are not allowed to be deferred, because typically those policies, the amount to be received is a result of price declines, and that market yield, market number is usually 1 year after harvest. So it's not allowed to be deferred. So now we've got the next piece. So that was the crop side of it. When we get into the livestock, a little different ball game, but not a whole lot different. We have weather-related sales of any livestock. That can be calves, that can be breeding animals of any kind, pigs, etc. And they may be deferred. I give you the code section there, 451G, just to help out. You make an election to defer reporting of that income from livestock sold in excess of normal sales. Well, we've got the drought, flood, other weather-related conditions. This hurricane is going to apply. So if we had to sell off a lot, basically, if we've had to sell off the entire herd due to the drought, we can still elect to defer to the next year anything that would have been not normally sold in 2024. We can report that in 2025. So including income, the extra sales, and the tax year following the tax year in which the sale or exchange occurred. So under this specific code section, this is a 1-year deferral. So we're just moving income that we're forced to be reported in 2024, but under normal circumstances, we would have reported that in a later year. Consequently, we're allowed to defer that to help, again, reduce the impact of bunching of income and to more accurately reflect what our normal business practice would be. So our principal business has to be farming. 50% or more of our income has to come from the farm. Again, they must use a cash method of accounting. Then we have to prove that we have, under our normal business practices, the net sale or exchange would have occurred in a normal year, but due to the disaster, the animals were sold in a disaster year. We have to explain that the conditions caused the area to be eligible for federal assistance. Presidential declared disaster area, Department of Agriculture, Secretary of Ag can also do this. Could be some other federal departments or agencies. All we have to do is prove that the area was eligible for federal assistance, a federally declared disaster area. So what gets deferred? It's the gain on the sale of those animals in excess of normal. So that's the difference between the quantity sold and the quantity that would have been sold. The number of head that were sold versus what would have been sold under normal business practices in a normal year. So we look at then, we have to go through all the facts and circumstances. Typically, we require looking back 3 years to look at animals sold in each of those 3 years to determine then what is normal. Anything above that 3-year average would be considered abnormal, the excess. If we haven't been in business very long, then the IRS looks to what others in the area in a similar situation would be doing and give the new farmer the benefit of the doubt. So it doesn't hurt. So again, we're required to make a separate election based upon the category of animals, that being hogs, sheep, beef cattle, dairy cattle. They're all separate. We don't have to worry about sex, breed, or age. If they're held for sale in the ordinary course of business, it has to be made by the due date of that return, including extensions. So we decide to make the extension, we're allowed then to take that much more time to get it in place for that particular year when the drought or weather-related condition occurred. Livestock are held for draft breeding and dairy purposes. It can be made then at any time in a 4-year replacement period if we have a federally declared disaster area. So instead of 2, we got 4 years to buy them back. Don't get that done, you have to go back and amend the tax return in the year that you made that 1-year deferral or the 4-year replacement decision. So if you change your mind, you have to amend that return for the year that you made the election. Here's an example. Pasture flooded in 2024, severe storm, farm located, federally declared disaster area. Due to that flooding, they sold 150 market animals, including the 100 head that they would not have sold until 2025 had a flood not occurred. They get $270,000 for the cattle sold. They're cash basis farmers. The rules allow him to defer for 1 year the amount he received from the 100 head he sold due to the flood. So we do a calculation, there's 250 total sold, 100 would be allowed to be deferred. The regular 150 would be shown up in the year that they would have been sold. He reports $180,000 of gain of his income in 2025 instead of 2024. That's 100 head divided by the 150 total. He attaches a statement to his tax return showing all the calculations. And here's what is needed. Don't want to necessarily go through that, but it lays out all the processes, where the flooding occurred. There was a disaster area designation. The designation or declaration is attached to the return. And then it will show in 2021, 22, and 23 how many sold, and then how many was sold in the 2024 year when the flood occurred. Then at the very bottom, he says he's deferring that income attributed to that attributable to that 100 head of cattle that would have normally been sold in 2025. Now the animals not necessarily need to be in the disaster area. For example, let's say the hurricane messed up our land in North Carolina. We have some land a little further over, and those animals are ready to be sold. The animals in North Carolina weren't. We can sell the animals off in Tennessee, move these animals there. We still have the same scenario. We sold more animals due to the disaster. Consequently, we're allowed to do this, even though the animals that we sold were outside the disaster area, but we did not, and we simply moved the animals in the disaster area to the different pasture. But we have to show that the reason for that sale in excess of normal was due to that weather-related condition, due to the flooding, the impacts of the flooding, etc. It caused loss of either water, grazing, all of those pieces. And that the cost of feed basically was the reason that we got rid of those extra animals. Couldn't afford to keep them. Now, here's a different option. So the previous one was looking at animals held, and we were going to just postpone it for 1 year. Now we're going to decide we're going to take, these are draft dairy breeding animals, and we're going to defer the gain by buying those animals back. Doesn't apply to poultry. The draft breeding and dairy animals. To sold again by the drought, flood, other condition, and the sale would not have occurred under their normal or usual business practice. Then we're allowed to postpone buying those back, or postpone reporting the gain by simply electing to buy them back. There says there's no requirement for a federal disaster. Just have to prove the weather condition caused the sale, so flood, drought, etc. But if we do get a federal disaster declaration, instead of having 2 years to buy them back, we've got 4. So here's what's going on. Postponed gain. Generally purchase replacement animals within a 2-year period at the end of the year when those were sold. If it's eligible for federal assistance, the replacement period is extended to 4 years. If conditions persist, and typically this is for drought areas, if drought conditions persist, this 4 years can be carried further out even than that. I've got a county in Oklahoma that have been in extreme, exceptional, severe drought for the last 19 years. So it can go on for many years. I've got farmers that made that election 19 years ago and they still haven't bought them back. There's the IRS notice. Plus then when it was put on, then there's an Internal Revenue report listed there as well. Provide this to your tax preparer. Replacement livestock generally have to be the same kind as the original. Breeding heifers for breeding heifers. Now, due to if it's impossible for you to buy those animals back, so let's say we were to have that dairy that I've been using here for quite a while. We washed away the dairy barn. It's not going to be feasible to rebuild the dairy, get back into the business of dairy. We can go into beef animals. If that's not good, we can go into sheep, goats, etc. All we have to do is invest dollars for dollars. We can't get into real property unless we have soil contamination. And I assume that the soil contamination from the hurricane, if we like a lot of salt water, I'm assuming that would probably give us a situation where there's certain plants that don't grow very well. We may be able to do some other things to reinvest in different assets and still avoid reporting that gain. The next example, Tia here, she sells 5 raised breeding heifers. Due to 2024, she sells 20 because of her pasture was flooded. She loses out on the grazing of that. The basis of those animals, since they were raised, is 0 because of the weather-related event. She can elect to postpone 21,150. That's 3/4 of that 28,200 because she normally sells 5. She had to sell 15 more. So the 15 more are treated as the involuntary conversion. The statement that's included in the return is here. It's the flooding conditions, tells about the need to sell 20 additional cattle, and that they have a 0 tax basis. And then we're making the decision to buy them back. So once you repurchase them, that's 15 replacement animals. Let's say she repurchases those in 2026. Her basis in those, as long as she pays the exact same price as what she had, so that 21,150 of deferred gain, if she spends exactly that amount, her basis in those new animals is 0. She explains this in a tax return or statement return showing that the date, the type of animals repurchased, the cost of those animals, and then the information reported on the 2024 return. If she pays less than 21,150, she has to amend the 2024 return, and the difference is then included in income. If she pays more than the 21,150, she'll have depreciable basis in those animals, and she can write them off using the current depreciation rules. So the issue is making sure that you pay at least as much so that you don't have to go back and amend the return and report that income. So the considerations that you got to think about when making this election, and again, this is when it comes necessary to talk to your tax preparer. You're going to need to look at what your income tax brackets from the past are, what the current years are, and what you expect them to be in the future tax years to decide whether it is wise to defer that gain or go ahead and report it as income in the year received. Something else to think about, income averaging might impact that farmer's decision. Income averaging allows us to take a high income year, move some of that income into prior years. We're in a lower bracket, and we can get a refund from those lower brackets in those prior years. Something to think about. The self-employment tax liability. Again, another item to consider. The Section 179 expense election, depreciation, bonus depreciation elections have to be thought of. Again, your tax preparer can help you look at all these pieces. Do we have losses that might offset the income that we've carried forward from 2023 into 2024? And if we use that extra income, we can wipe out the loss. Income deferral may impact the farmer's eligibility for retirement plan contributions. How about the impact of other or off-farm income? We've got an off-farm job. Something to think about. Will the deferral affect the farmer's qualification as a farmer for other special provisions in the tax law? So those are the things you got to think about. That's where you need to sit down with your tax preparer. Those need to be evaluated to make a sound business decision as to which way to treat these deferrals. Do we report it in the year we get, or do we defer it to the following year or kick it down the road even further by buying replacements? These next few slides talk about some things that, since we had the hurricanes, what do we need to do to prove some of these losses? Reconstructing records. What's happened in this, when the hurricane went through, a lot of our historical information was lost. So IRS publication 2194, it's downloadable, accessible. It's a resource guide for disasters. It prescribes methods to reconstruct records that we've lost. It's likely essential for tax purposes to get federal assistance or for insurance purposes. So we needed to reconstruct some of those so we can get some of those benefits from federal or for insurance. Like I said, a lot of this is going to be lost, but it is reconstructible. Real property, going back to the courthouse, getting deeds, etc. Vehicles. Hopefully we've got someplace that we've got titles, etc. Maybe I'll go back to the dealer and find out what we paid. Same thing with machinery and equipment. Personal property gets a little tougher. Things in the home that we lost, well, those are allowed, but deduction, but it may be a little tougher to get what those costs were. Business records. Hopefully your accountant's got some of that for you. So if yours were lost, we should be able to find those. I find most often, most of this information is available unless we go through a severe fire and the fire destroys everything. Most of the time, some of these numbers are available. More things to do. Hopefully you've got photographs. A lot of us don't. But if you do, that's a great place to start. You've got to take photographs after the loss so it reminds you what was on the property. Building sites, etc. Machinery and equipment showing what was damaged. Inventories that were lost. Hay, feed, etc. Get receipts for the purchase showing how much. Our tax records. Your accountant should have the depreciation schedule for your depreciable farm assets, tractors, machinery, equipment, breeding livestock, etc. Federal disaster declaration reports, those are available on the FEMA website, also on other websites that you can get that information to support your decisions and the tax return elections. Also, very important, get with your tax advisor as quickly as possible. If you haven't already, do so, because it is very important to bring them up to the speed of what has happened. They can help as well. Here's some references we put together. There's a couple of things on ruletax.org. Disaster and related tax rules, it's a fact sheet. It's RTE 2022-07. In that fact sheet, it talks about there's examples of all kinds of property that was lost due to various events and how the losses were calculated for those different assets. It talks about in there how to reconstruct your records with some detail. It also provides a list of other IRS publications and resources that are available to help you work through these disaster situations. There's also a rule or a tax guide for owners and operators of small and medium-sized farms. It provides, again, detailed information that will be helpful. So with that, I've taken about 1 hour and 20 minutes. Thank you for attending this workshop or this seminar. Please, after this is over, if you have follow-up questions, forward those to Janet. She will forward those to me. I will answer them. I would like as much information about your question as possible. And don't just say I lost a barn. Give me some more information. Then I can be better able to help answer the question, provide guidance, etc. So with that wraps up the project. So Sarah, Janet, what are the questions that are out there?
We have some questions that came in kind of at the beginning of the presentation. One was, is there a good place in the IRS information to determine what is a qualified disaster loss versus a disaster loss? They are in a county with a disaster, like a presidential disaster declaration from June 2024, but they're having issues in determining whether it's a qualified, so no AGI limitation, or not, so only Schedule A itemized deduction.
If they will go to that publication that I provided, let me see if I can go back there. Reshare the screen. They will go to this publication 2194. It's a resource guide. It also lists other disaster resource publications as well. Also go to the irs.gov website. If you'll type in disaster information, you'll get more things there than you probably ever want to look at, but it does provide some great sources to download and look at. Basically, they're much more specific as to the topic. That's a great place to start. Another place to look at in more depth is this fact sheet on the ruraltax.org website.
Okay, thanks.
So if they'll go to ruraltax.org and search for that fact sheet RTE 2022-07, at the very end of that, like I said, in this third bullet, a list of helpful IRS publications and other resources. And it does talk about then the AGI limits, other pieces of the puzzle that applies. And that small guide, the tax guide for owners of small businesses, there's also a disaster section in there, a chapter that goes into detail as well.
And this next question also came in at the beginning, though I didn't know which slide you were on, but the question was, can you split between tax years? For example, take half in 23 and the remainder in 24. I'm not exactly sure if they're talking about a deduction or...
The problem is, no, the only time we're allowed to move things between 2024 and 2025 would be on the sale of livestock or crops, insurance proceeds, where we normally sell part of the crop in 24 and we'd sell part of it in 25, or we have livestock where we would sell under normal conditions, we'd sell in 2024, but due to the hurricane, we had to sell more. Then that income could be moved into 2025, or if we elect to repurchase them, then we could postpone that indefinitely. Everything else, disaster loss, it could be carried back to a prior year and get a refund, but you're not going to be able to split anything between years.
Okay, thanks. And also just to flag for folks, we do have a recorded webinar on disaster and livestock related disaster sales. So there's some additional resources on farmers.gov/taxes and ruraltax.org. Okay, got a few more questions of coming in. Okay. Oh, here's an interesting one. Let's see. There were trees on the property to provide shade for livestock, but due to the federally recognized drought in central Texas, the trees died. They need to erect shelter to replace those trees to provide shade for livestock. How can that be handled on their taxes?
The value of those trees are lost because there's no way, under the tax law, those trees have to be for a business purpose, like pecan trees, nut trees, etc. And you have to have a basis in those trees, and they have to have a value of producing a crop of some kind. Shade trees will not work, and that's the worst part about it. So if you have to put up a structure because of the loss of shade, well, the cost of that structure can be written off using the bonus depreciation rules, section 179, if it's a single purpose structure, etc. So there's no benefit, there's nothing for the shade trees to give you any benefit. Sorry to say that.
All right, let's see. Okay, our cleanup cost deductible, sand and rock on farm fields.
Cleanup. So I'm assuming when they say cleanup, is it due to the destruction from the hurricane, or is it just simply going out and moving the rocks? If they're simply going out picking up rocks so they can utilize it for farming, the only thing that you can do if you hired somebody to come in and pick those up, the cost of that hired labor would be deductible, but the other costs, no. If you're looking at due to the destruction of through a hurricane, yes, and depending upon, again, then if we have a new structure being put up, the cost of that demolition and cleanup is then added to the basis of the land. Hope that answers the question. It may not. They may need to give me some more information through an email to Janet so we can truly get into the issue of what's going on.
Yeah, it sounds like hurricane damage, because the follow-up question was also about trees on fences that has
And
to.
yeah, to take the trees off the fences, basically like that. The cost of then repairing the fence is allowed as a deduction too, so. Repairing, replacing, et cetera.
Okay. Let's see, and then
That information on that one, if you'll go to the realtax.org website and pull up that fact sheet, that has a good discussion on fences and replacing, et cetera.
and let's see, there's a question about disaster designation, where folks can find a comprehensive list of those presidential disaster declarations.
What I've done is went to Google and typed in presidential disaster declarations, and it will usually take you where you need to go. You can also do the same thing with FEMA. They're listed in both places, and they're listed by state and by year. So if you're looking at a specific year, it'll give you all of them nationwide, or if you're looking at a specific state, I think it'll give you several years worth of those disaster declarations applicable to that state.
Correct. And FSA will also, we have a like online, if you search as well, you can find which counties and areas have disaster designations. And I also recommend using our disaster assistance discovery tool on farmers.gov. That's another kind of great resource to see what disaster programs you might be eligible for as well. Yep. All right. I think that is all of the current outstanding questions. We folks had, I think they're just searching for links to some of the publications you mentioned, the IRS ones, but I'm assuming that those will be embedded links in the PDF when we have the slides available, so folks will be able to access all those reference materials there, and also they can all be found at irs.gov. And if you search, basically, like JC said, natural disaster, all of those publications come up as well. Well, thank you everyone for joining us. Anything to add, JC, before we wrap?
Like I said, please, if you have more questions or as things pop up that you want to know about, send Janet an email. And she will forward that to me, and we'll continue, we'll do our best to give you help and information. Just thank you for attending this session.
Thank you everyone, and have a great afternoon.